Good day, my viewers. Once again, it's been a while. I'm Abiola again on this channel. This is Accounts and Business. Today, we'll be quickly looking at the accounting policies, principles, and conventions. What are accounting conventions and concepts? They are the guidelines upon which the procedures and policies of accounting are based. First on it is an entity concept. This is a concept that explains that business is treated as a separate legal being from the owners. That means the owners are different individuals by law, and the business is a different individual, which even means that the owners can sue the business and vice versa. Duality concept is another concept that says that all transactions, each of the transactions of the business affects two parties. One party gives and the other party receives. That means the double entry system says that for all debit entry, that's receiving in the transaction, there must be a corresponding credit entry. That's the giving in the transaction. Just like when there is a giver, there is a receiver. That is duality concept of accounting. Another is money measurement. This is quite interesting and very funny, but very necessary to note. Money measurement is a measurement that accountants take note that it is only values or items or transactions that have monetary values that can be recorded in the accounts. It means that transactions or items or what have you, anything whatsoever which cannot be quantified in monetary terms cannot go to the accounts. It is, for instance, the skills, expertise of staff of a business might be difficult to quantify in monetary terms, hence might not necessarily go to the books. But wages and salaries can definitely be quantified, and it goes to accounting books. The next concept is a consistency concept. There are different ways we can put our accounts. There are different ways we can treat our assets. There are different ways. For instance, depreciation. We can use different ways to depreciate the assets of the business, like the straight line method, reducing balance method, annuity method, and the rest. Even to value inventories, we have different ways. We have FIFO, first in, first out, LIFO, and AFCO. We'll treat that in another topic, another day. So, if any method is being used, it must be put to use consistently. This will allow even our users to have good reflection on the performance of the business and to show better picture of the business. Not that you used one last year, you are changing the mode of depreciation, for instance, this year. It is necessary to consistently stick to any method you want to use to value or to show your account. Another is the accrual concept, which is the same thing as matching. Matching concept or accrual concept says that revenues within the year, earned in the year or within the year, must be matched against the expenses incurred during the year to ascertain the profit, which means that expenses that are prepaid, for instance, for the following year will not be counted for this present year, or expenses accrued this year is part of this year, whether it's been paid or not. Expenses must be shown for this year. The same thing goes for revenues earned during the year. Once you have earned the revenue, whether it's been paid for by the customers or by the clients or not yet, it must go to the books. Another is a realization concept. This explains that once goods or services have been passed from the business to the customers or to the clients of the business immediately has realized the income. It means that when, for instance, goods are sent from the business to the customers, immediately the customer receives the goods and confirms the receipt without any defaulting goods, that means the business has realized the income. Whether the customer pays immediately or later, the income has been realized. That is realization concept. The next concept is a historical cost concept. This explains that our assets, the non-current assets, are shown at their cost values. For instance, over the years, some assets may, for instance, land, may have increased in value. To do this, we need to be careful. Items must be shown at their cost value, because at the purchase point, the source document will usually be issued, like the receipt or the invoice. When this happens, that cannot be changed even when this asset is reducing or increasing in value. Hence, the cost value must be shown in the statement of financial position, deducting aggregate depreciation to give us our net book value. The next is going concern. This is also very important, and it applies to the incorporated businesses, that is businesses that have been registered as a legal being, as a company, private limited company and public limited company. Going concern is a concept that assumes a business to still be in existence for the foreseeable future or till perpetuity, regardless of existence of the owners or not the owners. If we won't forget the entity concept previously explained, that the business is different from the owners. So whatever is happening to the owners is separated from the business. Hence, the continuity of the business is important, and the business is assumed to continue to exist for the foreseeable future. That's why when we prepare the accounts for income statement, it will be income statement for the period ending. Assuming rather that the business will exist for the next period. Also, for statement of financial position, it is as at a date, which assumes that the business will run for the next day. That is going concern concept. Next is a prudence concept. It means that accountants have to be careful, the same thing as conservatism. When we are evaluating or showing our assets and our income, we have to avoid estimates or unnecessary assumptions of increase in value. We need to wait till the income is realized before it's brought to book. You cannot estimate a future increase and put it into account. It might be tricky. However, for cost and expenses, once you estimate increase, you put it down, because if it eventually happens that the cost increases, that is okay, you've already provided for it. And when you are showing your assets, it must be asset less depreciation, inventory, lower of cost and net realizable value. For debtors or trade receivables, that is the trade receivables less provision for doubtful debts. This will show the true value of the assets of the firm. The next is materiality. Materiality shows that some items are treated more material in quote than the other by different businesses. The same assets. For instance, this item I'm holding, this remote control, it's just an item. So the purchase cost will be just like a stationary cost, which is just a mere expense. But the firm that sells this to me is going to treat this item as an inventory. It's a stock, it's an asset, a current asset to that firm. But to me, it's just an expense. It is not material to me. To the firm that sells it, it is an asset. That is materiality concept. And the last for this class for now is a substance over form, which explains that some items or assets are put to use even when they have not been legally owned. For instance, when you hire purchase or you lease an asset, you can put it to use, which means it will come to the record, to the books of the account, but yet legally it's not your own. Since it's been put to commercial use, it must be put into account. This is where we wrap it up on this class today on accounting concepts and principles. Thank you very much. After this video, please like and subscribe. It is Accounts and Business with Abiola. Thank you.